Welcome to my mortgage channel. Hello, this is J. Mike Perkins, and on this episode, a mortgage with a name that only an accountant could love, debt service coverage ratio mortgages. So what are debt service coverage ratio mortgages? Well, they are a loan product for real estate investors. You can't use this type of loan to buy or refinance any kind of primary residence. The main feature of the program is this: the lender does not ask the borrower for copies of their income documents. Instead, the income to qualify is based on the financial performance of the rental property itself as measured by the debt service coverage ratio formula. Obviously, debt service coverage ratio is an accounting concept that's being applied to a loan program, but it is very descriptive because that's exactly what the lender is going to do. Now, because debt service coverage ratio is kind of hard to say over and over again, you will often see it abbreviated as DSCR. The DSCR is going to be your net operating income, as determined by the lender, divided by the total debt service. There'll be a number. Now, the lender can require whatever the lender wants to require, but something around 1.25 is common. If you're going to try to figure out whether you qualify, you obviously need to understand what net operating income and total debt service are. Net operating income is typically not the same thing as the rent. There'll be certain expenses that the lender will deduct from the rent to come up with the net operating income. They include things like property management fees, an allowance for maintenance, and any other mandatory assessments on the property. Total debt service is going to be the principal and interest on the mortgage, plus taxes and insurance and HOA fees if applicable. Let's look at a typical calculation. Let's say that you have $3,000 a month in rent. Then you have a $350 property management expense, and you have a $300 a month allowance for maintenance, and that's it, and you end up with $2,350 for net operating income. Let's say the debt is $1,880. Divide the $2,350 by the $1,880, you'd end up with a 1.25 debt service coverage ratio, and that's about the number that the lender is looking for. To do one of these loans, your credit has got to be good. The lender is typically going to want a larger down payment, something around 20%. The interest rate is going to be higher than what you typically find on a conventional conforming mortgage. And you may have to have a little money left over in savings to meet a requirement that the lender calls reserves. The sort of person that would do one of these mortgages would be a real estate investor that, for whatever reason, does not want to provide their income documents to the lender, but has a property that makes enough money to satisfy the debt service coverage ratio calculation. Thank you very much for watching. This is J. Mike Perkins. If you would be so kind, would you mind hitting like and subscribe?